Good afternoon and welcome this afternoon to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. Joined out there in the chat by my good friend Kevin Horner, who is now going on a 30-plus year stint as a market veteran. We're glad to have Kevin on board to help answer questions. By the way, Kevin's going to be with me in Dallas this weekend for our live event coming up, our Advanced Options Workshop. Kevin's going to be there helping out as well. So keep Kevin busy in this discussion today. Ask him some questions along the way. If you're watching this in the recorded version, we're glad to have you here with us as well. Make sure that you leave us a comment in the comment section. Boy, I'll tell you what, it's been an interesting market since last week. And we talked about a few things last week in terms of market movement that have come to fruition. We also talked about some things that haven't, and we'll see how that plays out in the index markets. Plus, I've got kind of a newer index that I wanted to talk about today, simply from the standpoint of being responsive to consumer demand for index options. So we'll jump into that here really quickly. A couple of quick reminders, though, as we get into some of the housekeeping items that we need to take care of today. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy or account type or anything else. Remember that investing involves risk, including the loss of principal. If you're going to trade index options, make sure that you understand that they have a high level of risk. They're not suitable for all investors. Make sure that you read the characteristics and risks of standardized options. You understand those concepts before considering any option transaction, especially any index option transaction. Now, the index options that we're going to look at in this class, in this webcast, are all, by and large, European-style indexes, which means that they can't be exercised until expiration, which means that there's not early assignment risk if you are short those options. However, an American style option is different. An American style option can be exercised at any time between the time that you purchase the option and the time that it expires. Therefore, American style options have early assignment risk. So at any time you're short an American style option, there's the potential that you could be assigned that obligation early, whether it's in the money, at the money, out of the money. It doesn't matter. Now, we'll talk about some of the characteristics of those European style options as we get into this discussion. A couple of other quick reminders. There's no guarantee in using a stop order that stop order is going to get filled at or near the stop price. Also, we're going to use some technical analysis in this discussion today. It is not the only way to evaluate the market. It is simply one way to evaluate the market. It is theoretical in nature, as is probability analysis, as is fundamental analysis. And so none of those are guarantees as to what the market is going to do. Now, we're also going to be using the Thinkorswim desktop software platform, specifically the paper money version of the platform. It is a great learning environment. It is not, however, a guarantee of future success out there in the real world. And it does not do certain things that a live trading account would do. One of those is it does not facilitate the early assignment of American-style short options. But two, it also may give a perception of order fill prices that might be a bit erroneous from a live trading environment, because the paper money platform nearly always fills orders at or near the midpoint between the bid and the ask. And so that might be a little bit deceiving when you get out there into reality and those orders don't fill exactly at those levels. So something to pay attention to as you move your practice from paper trading to live trading. So let's jump into the discussion here today. Let's pop over to the Thinkorswim desktop software platform and see what's going on. It is an interesting day. We're taking a look right now at the S&P 500, and I'm going to zoom in. This is a one-year daily chart. I'm going to zoom in a little bit over here on the right-hand side. We're going to see what's going on with that index. Today, we saw that gap up, obviously, on the 2-week ceasefire news, right back up to the 50-period moving average in this particular case, well above well above is a relative term, well above the 200 period moving average. But remember, we had been below the 200 period moving average for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, roughly 14 days, 2 weeks. And that kind of put us in that position of being in a bit more of a bearish perspective. Now, that remains to be seen. Now, I know Kevin Horner talks a lot about this in the webcasts that he teaches on a regular basis, the Trader Talks in today's market webcast, where he talks about the Horner rule, where you got to see some confirmation when you see a breakout. And that is, maybe you get 1 or 2 days of confirmation move above, say, for instance, that 200 period moving average, just to make sure that it's doing exactly what it is suggesting that it is doing, and it's not a false breakout. So in this particular case, we have one particular candle. It might be that relief move above the 200 period moving average on the S&P 500 on the broad market. We take a look at the NASDAQ and we see once again kind of same thing, but a gap up and a little bit of a sell-off. The 200 and the 50 were coming closer together here than in the S&P 500, and coming pretty close to that little kiss right there between those two. Not yet necessarily a death cross, but death crosses usually come late. This may not stop the death cross. This gap up and a little bit of a sell-off may not stop the death cross from occurring, but in perhaps the worst case, if the market continues to move higher here, maybe we get a little bit of a whipsaw and that 50 starts rising once again and continues to move back to the upside. Nevertheless, the NASDAQ, which saw some of that rotation out of some of those energy stocks and back into some of the technology names, now seems to be selling a little bit of that off, a little bit of profit taking perhaps up to this resistance level. That's going to be important here in just a minute, and I'll show you why. Now, take a look at the small caps, and the small caps on a percentage basis up about 3% on the week, just about the same as the NASDAQ, a little bit more so than the S&P 500. So it would certainly seem that the small caps, at least at this point, perhaps the bigger winner. Again, above the 50 period moving average, the 15 to 200 were not close together in this particular case. They were converging, but they were not close together. We had that kind of Rachel Daschle special inverted or kind of skewed double bottom here price pattern. By the way, our good friend Rachel Daschle, one of our great education coaches, teaches a webcast on price patterns. So if this is something that appeals to you from a technical analysis standpoint, check out her webcast as well for all things price pattern. But we see that breakout here and that reversal. Does it change the trend? Well, again, this is where that Horner rule, kind of waiting to see that confirmation, may come into play. Nevertheless, it disrupts some of the perspective that we had on some of these other index options. So what I'm going to do first is we're going to spend just a couple of minutes managing our ongoing strategy, which is an SPX strategy. And you can see that the SPX kind of just stalled right there, that 50 period moving average once again. But the SPX strategy that we've been employing and building some consistency over the course of the last year and a half has been the idea of selling a vertical spread at 14 days to go until expiration, and then buying that vertical spread back at 7 days to go until expiration, trading on and banking on and structuring the trade around the idea of capturing rapid time decay in the first week of that trade and then buying it back come what may. Now, we've talked about this a long time. Many of you have gotten to the point where you felt that maybe it's a little bit boring, which is fine because repetitive, consistent, boring trading may be a strategy that appeals to some traders. The ability to be repetitive and consistent in that repetition is something that perhaps appeals to some traders. Again, not advocating any particular security or strategy here. But the idea is that a couple of things have changed from last week to this week. One, the trend, or at least the short-term trend, of the market perhaps has changed. And volatility has certainly changed in the last week. So I want to pop down here to our VIX grid really quickly. And I want to take a look at what's going on with VIX. So we see VIX dropping below its 30-period moving average. It has not dropped below its 30-period moving average and stayed there. Now, we're not closed yet. There's still, I suppose, with less than an hour ago in the market, there is the possibility, if news were to come through, to see a big move in the VIX back up above that 30-period moving average, but not likely to do so. We can go back and say, hey, we're back in January, the last time we really saw the VIX staying well below or below its 30-period moving average. We saw some touches below that level, but we didn't see any closes below that level. Now, potentially, if things go to the way that the market is moving currently, the VIX is maybe settling back down below that average. And Ricebird says, yeah, enough with the adrenaline market moves here, right? Some traders like a boring market. And I don't know that a 21 handle VIX or 21 half handle VIX, might be considered to be a boring market, considering the average for the VIX over the course of the last 3 years has been about the 16 to 18 level in the VIX. And so we're still relatively elevated, but we're not up in the 35 or 40 range. We're certainly not up in the 55 or 60 handle on the VIX. So volatility has bled off. Now, for that 14-7 strategy, which we were employing short vertical spreads, a drop in volatility certainly can be beneficial. And that's very likely what's been happening here. Now, nevertheless, I said last week, and I said the week before, that what happens when we are in a position of selling into possible market rallies is that a rip your face off rally could put us into a situation where the trade takes a loss. So let's go to the monitor tab and let's take a look at at this particular strategy and what's been going on. So last Wednesday, we sold a 68.75 call and we bought a 6900 call. We went a little bit wider just because of where those strike prices were aligned. The idea being that our expectation was that price was going to stay below those levels. And it is still below those levels. The SPX is currently sitting at 67.60. Of course it's 67.67. Kevin, come on. Did you do that on purpose? 6767? Probably so. Kevin's kind of like that. Anyway, we're in this short vertical spread at the 68.75 short strike, long the 6900. So 25-point wide vertical spread. We sold it for $1.80. And we made the comment last week that what could tag this, what could put this into a position of taking some kind of loss would be a rip your face off rally in the market. And we knew that was a possibility. So that's kind of what we got. And that's kind of where we are at the moment, potentially taking a little bit of a loss in this particular trade. Now, what I'm going to do is I'm going to shift my chart here really quick. And as I shift the chart, we're going to change this chart to, I'm sure he did, Kev. I'm going to change this chart to my index grid so that we can kind of see how this plays itself out. Now, I will share this with you as well for those of you that have not been with us before. And I'll share this grid right now just by clicking on Share Grid. We'll go ahead and share it. And remember, anytime we share anything, it is for illustrative and educational purposes only. It is not guaranteed as to time or accuracy. The left-hand side of the grid is simply a one-year daily chart. The right-hand side of the grid is a 3-month, one-day chart. On the left-hand side, we kind of have those trending indicators. We have a 200-period moving average. We have a 50-period moving average. And we have a MACD, a moving average convergence divergence. So on the right-hand side, we have two other indicators here. And I've got implied volatility indicator. You can see what implied volatility has done. That matches up roughly with the VIX, although implied volatility here is not exactly the same as the VIX. It's going to be close. And then I've got this probability of expiring cone. The probability of expiring cone simply draws a line, a parabolic line, at one standard deviation based on implied volatility. And we use that as a means to locate the strike price and the time, the duration for our 14.7 trade. So the first thing I'm going to do is we're going to go back to this monitor tab. Now that we've got this kind of lined up here, we know what we're looking at. I'm going to go back to this particular trade because the rules of this particular strategy, as we have established them, is that at 7 days, when we come back to this webcast every Wednesday, we buy this trade back in, come what may. Whether we're taking a loss, whether we're taking gain, but that's just the consistency of the strategy. Sometimes we're going to take a loss, sometimes we're going to take a gain. In this case, we're taking a little bit of a loss. Brought in $1.20, we got to buy this back for $6. So we're taking not a max theoretical loss, but we are taking a loss in this particular trade. And sometimes that's okay. And you know, here's the thing. Many of you have asked the question either in the chat or in the comment section, could I manage the trade this way? Could I put a percentage exit? Could I manage the stop this way? And the answer is absolutely yes. Do it the way you want to. What we've been trying to do with this particular strategy is just simply establish that consistency week to week to week to week. So what I'm going to do is I'm going to buy this back, come what may, and we're gonna try to work that just a little bit right down to that $6 mark. Click on confirm and send. We're going to close this one down. And we closed it down. We ended up taking a little bit. We got it for $5.90, which is better than $6. We ended up taking a little bit of a loss on this trade. And that's okay. We know that we're going to have losing trades. So let's now go back to the option chain here. And I'm going to just locate time-wise our 14 days to go until expiration time. And that's going to be our 22 April expiration. That's putting us out to this 14 days to go until expiration timeframe. So I'm going to go back to that chart. I'm going to take this vertical line that I've got, which is just simply a time hack. It's this time level tool in the drawing tools. And I'm going to right click and I'm going to activate it. And I'm just going to push it out forward in time to April 22nd. And we're going to set that line in place. There's that line at April 22nd. Now that we know where that time is, right? Now that we know where that time is, we now have to locate where the S&P 500 is relative to the 200 period moving average. Because remember, the rule is this in establishing this strategy. If the S&P 500 if the index is above the 200 period moving average, we sell a put spread. If the index is below the 200 period moving average, we sell a call spread. So we've now flipped the S&P 500 is above the 200 period moving average. Therefore, we're going to be selling a put spread. So we're going to come down here to the bottom side of this probability of expiring cone. I'm going to grab my line tool. We're just going to find the intersection of those two at 64.90. 64.90 is going to be our intersection. We're just going to draw that hash mark there at 64.90. That crossover is where we're going to locate our short strikes. Yeah, so Abby asked the question, how many of these have been profitable this year and what's the amount of profit made so far in the strategy? I don't know the exact numbers, to be honest. I know that that the win rate is better than 60%. So winning better than 60%, we've had like 4 or 5 over the course of the last year. Max losses, we've had maybe a few more than that of some loss, but the majority of them have been nearly max gain or close to that, or some gain, but the win rate's been better than 60% in this particular case. And that's anecdotal because, of course, we can't in this environment because these are illustrative and educational purposes. For illustrative and educational purposes, we don't share nor account for those ongoing characteristics, right? The statistics. So speaking of statistics, Kevin just posted in the chat there the feedback survey. We'd love to have you fill that out, help us out, and make these sessions better for you. It's really quickly 2 minutes. It helps us out immensely in being able to make these webcasts better for you. Just click on that link, set it aside. You can come back to it at a later time and fill that out. You don't have to do it right now, so that you're not focused on that. We can focus on what we're talking about. So 64.90 is where we're going to locate this short strike. And we're going to come back over here to the trade tab. We're going to go out to the 14 days to go until expiration, the 22 April. I'm going to open up this number of strikes, probably out to about 125 strikes or so. And we're going to scroll down. We're going to look for, actually, I've got to come in a little bit. I don't even have to go out 125. I can probably go out 110 strikes. Let's see, because we're going to get to the 64.90 strike. The 64.90 is going to be right there. 64.90 strike. And the one thing I'm going to do is I'm going to change my layout to delta, theta, and vega. In fact, I'm going to change it to delta, gamma, theta, and vega because I want to see what this looks like. So we're going to go to the 64.90. We're going to look at selling the 64.90. Pretty tight bid-ask spread, 30 cent wide bid-ask spread in a 17-cent delta option. Pretty far out of the money here. So we're going to sell the 64.90, and we're going to buy the 64.70. So we're going to make this 20 points wide. The reason we're making it 20 points wide is because that gives us a little bit of flexibility. It's got a bigger max loss, but this is also a high probability trade. So we're going to sell this short put vertical spread at about the 17-cent delta, one standard deviation. We're going to bring in about $2.30 theoretically of premium in this trade, which is a little bit more than we brought in last time. We only brought in $1.80 on the last iteration. So even though volatility is decreased, we're still seeing a little bit more skew perhaps to that put side. So I'm going to click on confirm and send. We're going to read through this order, make sure this is what we want it to do. I'm going to put it in our weekly options group. And I'm bringing in $230 against a max theoretical loss of 1770. Statistically, probability-wise, not likely to get hit. But as we've just seen in the last 2 weeks, we've had rip-your-face-off moves that have put at least this week's into that some loss category, which is fine. It can happen. And it's okay to take a losing trade. In fact, sometimes it might be healthy to take that losing trade so that we recognize, yeah, we can take a loss managing our risk. This is the reason why we manage risk in the trade. So I'm going to go ahead and I'm going to click on send, and we're going to fire that order off. And we sold that vertical spread for $2.40 is what we got out of it in this particular case. So I'm going to go to the monitor tab and we're going to look at this. So we're going to look at this to come down. Now I want to come back. We're selling this for $2.40. We want to be able to buy it back 7 days from now, next Wednesday, for as little as possible. So that's ideal. If the price of the stock or the price of the index goes up, that's going to work in our favor. If implied volatility continues to come down, that's going to work in our favor as well. If we go back to that trade tab, and we take a look at the Greeks here, we take a look at the net Greeks, this is not a very sensitive, directionally sensitive trade. We're really not looking for a lot of directional sensitivity here. We just simply want the price of the index to go up. But we're short 17 deltas. So 17 deltas minus the 15 deltas of the strike that we're long gives us, 0.17 minus 0.15 gives us two remaining net deltas. So we're directionally sensitive to the tune of about 2 cents. No real gamma impact, especially this far out, 2 weeks out. On an index product, we're probably not going to see a lot of gamma impact as we get down to 1 or 2 days to go until expiration. Because there are multiple expirations in that final week, Gamma really doesn't start to accelerate until we get close to that 1 or 2 days to go until expiration. If this were a traditional equity that has either weeklies or just monthly expirations, gamma would become much more of an issue further out in time. But because there's more expiration cycles here, there's less of an impact to gamma until we get into those last couple of expirations. Now, what we're left with in terms of theta, if we think about what we've got here, so 2.55 minus 2.45, 2.45, whoops, 2.55 minus 2.45 theta, we're left with about 10 cents of theta sensitivity in this particular case. So 2 cents of directional sensitivity, delta sensitivity, about 10 cents of theta sensitivity, time decay. That's going to work for us as time passes, and it's going to work more rapidly for us right off the bat than it is closer to expiration because we're so far out of the money. And then in terms of our Vega sensitivity, 328 minus 311 leaves us with about 17 cents of Vega sensitivity. So volatility sensitivity, or Vega, is going to be our biggest impact, at least now. But as we get closer to expiration, that's going to drop off and become less of an issue. So if we get a further collapse in implied volatility right off the bat in this first couple of days prior to or after placing this trade, that's going to work fairly quickly again, or in our favor in this particular case. So as we're starting to look at this, again, we've got a not very directional trade with time sensitivity to a certain extent, with volatility sensitivity, but that volatility sensitivity is going away. The time sensitivity is going to be at its fastest right now, and then that's going to fall off. So we're kind of capturing. This is why we're doing 14.7, trying to capture kind of that sweet spot of these forces at work for us in this particular case. So Felipe asks a question, can I talk about how index options are taxed differently? I cannot, other than to say that they're, in some circumstances, they are taxed differently. I'm not a tax advisor. I don't even play one on TV. I don't even look like a tax advisor. I'm the last guy that you would think would be a tax advisor. Therefore, I'm not going to talk about it. But I will tell you this. If you contact your branch, your financial consultant at the branch, the Schwab branch network, we've got some great resources that they can put you in touch with. All right, so that's how we go about establishing this particular strategy and kind of doing this 14.7. Now, here's the other thing to think about. And I talked a little bit about this last week. I said we were going to maybe go to Charm School this week. Charm is the option Greek, the second order derivative that tells us how delta changes the further we are away from expiration. Charm, the option Greek charm, tells us that delta is going to change based on time to go until expiration. So here we are at 64.90. This is our short strike, which currently has a delta of 17 cents. So what I want to do now is I want to just go, and this is a quick teaser on charm. I will tell you this, Kevin's a pretty charming guy. I get that, but we're going to talk charm, which is a whole different kind of charm. Let's go to 7 days to go until expiration, to that 20 or 64.90 strike. And you can see that nothing else has changed, right? Nothing else has changed. Here we are at the 64.90 strike, but that 64.90 strike with half the remaining time to go until expiration has lost about 7 cents of its delta because charm has essentially taken away those deltas. Because the deeper this goes in or out of the money, the further this goes out of the money, the less extrinsic value there is, the less sensitive this becomes to the movement of the underlying stock. So if we were to initiate this trade, at 7 days and then close it 1 day to go until expiration, or 0 DTE, you're going to see that charm start to impact delta pretty quickly. This is going to become even perhaps a delta trade, a trade that's going to start to work against us directionally, which is kind of interesting. Because if we go out to our 1 day to go until expiration, the 9 April, and let's go to our 64.90, notice that we've got a 2-cent delta at that same strike. Nothing else has changed, right? Nothing else has changed. So we go to the 64.90. Now this becomes absolutely a delta neutral trade. We've lost any directional advantage. So here's the other thing to think about. So somebody asking the question, Lakshmi asking the question, could we hold on to this as we get to closer to expiration? Could you hold this into 1 or 2 days to go until expiration? Well, if you do that, you're not gaining any advantage directionally. In fact, you're losing any advantage that you had on this trade directionally because of charm destroying those deltas. If gamma is the bringer of deltas, charm and time are the destroyers of deltas, is maybe one way to think about that. So I'm not going to go deeper down that rabbit hole today because we could spend all day talking about charm in this discussion, because I've got some other exciting stuff that I wanted to talk about. So let's pop over here to the charts again. I want to pop over here to my single grid really quickly. And I wanted to bring up the NDX, the NASDAQ index, right? And we always talk about the NASDAQ as being kind of this tech-heavy index, right? And, you know, you think about what the components are of the NASDAQ. This is the NDX, the NASDAQ 100, right? So we could go to the Market Watch tab, and we could go to Visualize, and we could go to the NASDAQ 100, and you can see what those names are that are driving the NASDAQ 100, the NDX. And they're going to be these technology names. And a lot of these are going to be the Mag 7 or the Mag 10 names, right? But you've also got a bunch of other stuff in there. You got a bunch of other little things within this discussion, right? Within this realm of the NASDAQ 100. So if we wanted to just focus on, say, for instance, the Mag 7 or the Mag 10, the drivers, what have traditionally been the drivers of this particular index, how could we go about doing that with an index option? Now, we could do it with the NASDAQ 100, and we could trade, if we go back to the chart, NDX, we could trade NDX options, which we've done before. But that's a bit broader based than just focusing, say, for instance, on the Mag 7 or the Mag 10, right? So here's the thing. If we could focus our efforts on just those 10 stocks that have really been driving the NDX, the Magnificent 7 or the Magnificent 10, if you will, wouldn't it be cool? Wouldn't it be cool if there were an index that would let us do that? And we're going to go to MGTN. Now, because of the way that they list these, I have to go to MGTN :CGI. That's how you're going to see it on the chart, right? The MGTI. And we're going to take a look at this chart. You can see what's been going on, right? So as the Mag 10 have been rolling over, we've seen in the last few days a very strong reversal to the upside on that Mag 10. So we can use an index strategy. Now, if we were, we could create a trade on each individual component of this. We could create a strategy based on the larger NDX index, but this is kind of getting us down to that narrower focus. So what I'm going to look at doing is taking a trade here. I'm going to turn on implied volatility for this index so that we can see where that implied volatility is. We can see that implied volatility. Now, we don't have 52 weeks of history for implied volatility, so we can't get a really good percentile ranking over the course of a longer period of time. But just eyeballing this, I'm going to say that implied volatility for the MAG 10 index is high and falling, higher and falling. That would benefit a selling strategy, one where implied volatility is likely to continue to move to the downside, but maybe one that is not necessarily directional, right? We're getting some directional movement, but maybe we could be somewhat non-directional. So what I'm going to do is I'm going to look over here to the trade tab for MGTN. So I'm going to bring that up. And as I look at these options, so this is an index and Felipe is asking the question, how long does it usually take for volume to pick up on new products like the MAG 10? This is one that's getting some pretty good traction simply because this is an area where there are many investors who are looking for performance in, whoops, I knocked my microphone off, standby. There are a lot of investors that are looking for performance in this particular area. So let me see if I can get that microphone back on. Sorry about that. Yeah, there is a little bit of low open interest. It depends on where you might look. So what we're going to do is we're going to pop over here. I'm going to go out in terms of the time frame here. I'm going to go out actually to this end of the month, the 30 April expiration. And I've got fairly narrow bid-ask spreads here, depending on where this is. If we were to change this to volume and open interest, again, you're starting to see a little bit of open interest, a little bit of trading volume here in some of these products. But again, this is not a very well known product yet, but it's getting there. We look at the volume and open interest in some of the other products as we get closer to the at-the-money option. We get close to some of these other expirations. Maybe we go out to the closer dated ones. We're starting to see a little bit more open interest, not too terribly much. But we go out to this one that's the end of the month. That's been around for a while. There is a little bit of volume and open interest there. So what I'm going to do is I'm going to look technically. And I'm going to say, look, I've got a level of support here right around this 395 mark. So I'm going to come down to about the 390 or maybe the 380. Maybe we'll even sell the 380 in this case. Sell the 380. And we'll buy the let's see where there's some other, buy the 360. Let's make it 20 wide in this particular case and see what we get. So for a 20 wide, we're getting about $1.76. Not a huge amount of credit. So let's see if we can do a little bit better here. Let's see if we can go maybe to that weekly or maybe even out to this 15 May. Getting a little bit better out here at the 390, a little bit more volume and open interest there at some of these strikes. So here's what I'm going to do. I'm going to sell the 390. That's a 60-cent wide bid-ask spread. And I'm going to buy the 380. Let's see what happens if we do it 10 wide. So we're getting $1.95 on 10 wide, which is better than the $1.75 that we're getting on a 20 wide in the other expiration. But in this particular case, getting $1.90. In this case, look, unconfirmed and sent. So $1.90 against $810 of theoretical maximum loss in the trade. This is simply a short vertical spread. And we're going to put this in our index options group just so that we can keep track of it. I'm going to go ahead and I'm going to click on send after I read through this. All we're looking for here is the price of this index to stay above 388. And do that for the next, let's see, how far out are we here in this particular case? 37 days. So it filled fairly quickly, but again, this is paper money. There's a couple of contracts there of open interest. We can see there's maybe a little bit more, a bit further down, but that is probably volume that happened and open interest that happened before the big move to the upside today in that rotational effort. But we've got implied volatility moving. So if we put our delta, theta, and vega numbers on here, this is a trade that's got about 7 cents of delta sensitivity. It's got about 1 cent of time decay, and it's got a pretty good volatility sensitivity. So if that implied volatility continues to come down, that's going to be benefit. That's going to benefit us. So how did I start the spread order? I went to the chart and I looked for a level of support. I'm going to look at selling at or below that level of support if I'm selling a put spread. I went to the trade tab. I found that 390, which is under my 395 support level, and I held my control key down and I sold the 390, or clicked on the ask price or the bid price for the 390, kept my control key down, clicked on the ask price for the 380, and created that trade. So clicked on the bid price for the 390, held my control key down, clicked on the ask price for the 380, and I created that vertical spread by using that control key. It allows me to build a custom strategy like this. And then I went to confirm and send, ran through it, and then fired that order off. So that's how I put the trade on. So as we do that, all we're doing here is we're using an index product that doesn't have the ability or the potential for early assignment. So if this does start to move against us and then rallies again, there is that removal of that possibility that we get assigned early on a short vertical spread, like we might have with an equity or an American style option. So something to think about. If you want to learn a little bit more about this or about any of these other products or about any of these other ideas, I'm going to pop you over here to the Thinkorswim, to the youtube.com/@TraderTalks webcast page. And, if you wanted to learn more about short vertical spreads, verticals, right there, we've got a webcast that Brett Crowther teaches on Thursdays where he talks nothing but short vertical spreads. You've got Cameron May talking about vertical spread strategies. You've got Barb Armstrong talking about them. It's going to be one of the things that we're going to talk about in the Advanced Options live workshop coming up in Dallas this weekend, by the way. If you want to join us for that, we're going to be in Dallas for the Advanced Options Strategies workshop. That's coming up on Friday and Saturday this week. Kevin's going to be there. I'm going to be there. Kevin Hinks is going to be there. Alex Coffey is going to be there. Joe Mazzola is going to be there. If you can join us, come and join us. We would love to have you with us. And then we're going to be in Boston next week, which is going to be amazing. We haven't been to Boston since 2018. The last time that we were there, I fell off the stage. So hopefully I won't do that this time. So join us for those two events. We would love to have you be there with us for that. And remember to fill out that feedback survey. Click on that subscribe button if you're over here on the webcast page, and follow us on social media. My thanks to Kevin Horner for helping out today. My thanks to all of you guys for being here and being a part of this conversation. This is a lot of fun every week we have on this Index Options webcast, and we will see you again very soon. Take care, everybody. Bye-bye.